Whenever you want to start, the floor is yours.
Thank you. I'm just sharing my screen now. I hope that works. Good afternoon, everyone. So just a very broad outline of what we would talk about today. Really, I think what we're trying to focus on is, the interplay between finance and the financial sector's willingness, or maybe, lack of willingness today to invest in SAF production, and the policy aspect of what's needed to, instigate these investments. I'll try and spend less time on the context, but hand you over to Tony in 2 minutes. But essentially, there has been this movement of private financial institutions, right, the private sector, coming together to commit to net zero aligned financing. And Tony, was part of this umbrella organization called GFANZ, or the Global Financial Alliance for Net Zero. And within this umbrella organization, as you can see on this page, there has been a lot of, I guess, sector-specific alliances that has emerged since 2019. And it was in April 2021 when this umbrella organization was born. If you look at the members and sort of the assets under management column, right, this is, I think, updated for November this year. And you can see that it represents a veritable number of financial institutions and a large amount of assets under management across them. One thing to point out, and I'm sure Tony will point out as well, is that GFANZ has also recently launched an Asia Pacific network. So there is a group of financial institutions in the region who are also focused on the GFANZ activities. But without giving too much away, I will hand over quickly to Tony to really set the context for what the financial sector is concerned about.
Trying to find the unmute button. You'd think after 3 years it'd be easier. Hi everybody, I'm Tony Rooke, Executive Director at GFANZ, and I'm going to go through a little bit of what we've been doing over the last year or so. So thank you very much for those introductions. That actually makes my life easier. I don't have to explain who we are. In the APAC region, we've been really trying to accelerate net zero transition through 4 key strategic priorities, and that's to engage with financial institutions and recruit them to drive net zero objectives and decarbonising the real economy, providing research and analysis, engaging the public sector to really ensure that policies also support decarbonisation efforts and investment in the real economy decarbonising, and then also mobilising capital into emerging markets and developing economies. And going ahead, we're going to have 6 flagship initiatives along these 4 major areas. Just to highlight some of them, for example, we're developing 2 work streams looking at how we can support both a decarbonisation through managed phase out coal power plants, and also the transition of the steel sector as well. The reason I bring that up is it also is in context of our global efforts as well, which also looks at other sectors, including aviation. Over the course of this year, one of the things that we've done is, if last year was about getting a momentum behind financial institutions committing to net zero and being able to finance the decarbonisation of aviation, for example, but also other sectors, this year has been helping them to understand what that means and actually putting this goal into their strategy through net zero transition plan. So we have defined what that transition plan should be, a set of goals, actions, and accountability mechanisms for financial institutions to align with a pathway to net zero. Why that's relevant is that's the plan, but within that, we've also defined what transition finance actually means. And it's through 4 key strategies, which really sort of underpin how the net zero members, of which there are over 70 in the APAC region, will potentially be leaning into their transition plan and their strategy to help finance the economy. The first is the financing and scaling of climate solutions, and sustainable aviation fuel very much fits into that area. The second is helping to finance companies that are already aligned with 1.5 degrees and the net zero by 2050. The third is financing companies that are committing to align with those targets. And the fourth is financing the managed phase out of high carbon assets that cannot be decarbonized. And I think it's very much in sort of those first 3 areas that we will see finance goals and setting sector goals within the transition plan to help finance sustainable aviation fuel across the aviation value chain, the supply chain, as well as into the airlines and into the airports. But very importantly as well, financing the supply chain. So, for example, the feedstocks, the collection, the potential for renewable energy to actually help power these plants as well. So it's a real sort of holistic viewpoint of what needs to happen. Just so you actually understand what a transition plan for a financial institution, the action plan should look like, it should contain a foundational piece which actually says this is how we get to net zero. And then in the implementation and engagement strategy, this is really where the sector-specific actions should be taken. So whether it's implementing through their products and services, activities, decision-making, and policies and conditions that help finance SAF production, but also how they plan, how financial institutions also will engage both with clients and portfolio companies across the financial industry and into aviation sector, and also with government and public policy sector, because finance cannot do this on its own. It needs supporting policy frameworks as well. And it's really important to point out that finance will lean in and provide the finance for this, but it also needs policymakers as well as companies to work with as well. There will be also metrics and targets, and specifically how it sets financing targets into the aviation and supporting sectors, and overall a governance structure as well. Just finally, where this really hits the road in the aviation sector, we've produced this year also where we expect to see data to maintain a dialogue between finance and corporates in the corporate transition plan. That helps inform how financial institutions can lean in. That information just pulls on existing disclosure frameworks. And the other piece that we've been doing is how financial institutions can use sectoral pathways, such as produce using Clean Skies Tomorrow and the Mission Possible partnership work there, describing how the differences and similarities come about in them, what the investment requirements are to scale and decarbonize the technology there, and expectations, as I said, that's for sector-specific disclosures. And we have an upcoming report in the aviation sector, which very much focuses on the fact that all of the available pathways that we see that are freely available with data really point to the fact that we need a massive scaling of SAF finance. And as I said, we see that for financial institutions through the climate solutions and funding companies that are aligning to these pathways. So that's really an overview of what we've actually done and what we're planning to do. And handing back to Santiago, to Anne, I think it is, who's going to take us through the next piece.
Thanks, Tony. I guess it's me.
Oh, sorry.
No worries. Thanks, Tony. And I think what Tony has sketched out is a really critical piece of, from a top-down perspective, how financial institutions are really trying to support the transition by setting for themselves credible net zero financing targets, but also net zero transition plans. Now, over at the forum and the initiative that I work within called Financing the Transition to a Net Zero Future, we take a slightly more bottom-up perspective, right, to really work with these private sector financial institutions to figure out, now that they have set these targets and they're trying to implement their transition plans, how could they actually move capital or deploy their capital towards climate solutions like sustainable aviation fuel? And I think what we heard, in our research is that obviously they have made these commitments, but they are still, implementing these commitments is still a big challenge. And, the biggest challenges they face today in terms of supporting technologies like SAF is that, first of all, the risk and return profile of projects or the technology today doesn't always fit their current return expectations or risk appetite, and it becomes difficult for them to run the same deals or run the same projects through their regular investment committees and get them approved. Second of all, I think it's this idea that, or it's this phenomenon that, for today, there's still a limited pipeline of bankable projects. And by bankable projects, it means projects that have a sufficient risk return profile today that can be financed by a bank, right? So typically that means there's a long-term offtake agreement in place, meaning that's someone taking technology risk and so forth. Third really is political and regulatory uncertainty. And I think that covers a whole range from things like, whether or not there's going to be a clear recognition for SAF and other things like that, to things like whether or not the subsidies today for SAF production will carry on for the decade or so of the economic life of a production plant. And Anne would go a bit more into that in a later section. And then the last challenge that we identified really was that there was limited data today, as you would expect, right, on the risk return of these projects, just because the technology hasn't been implemented at commercial scale before. And I think on the risk return profile piece, right, just to make this problem come alive even more, like SAF production is particularly hard to invest in for financial institutions today because it falls into this, I guess, quadrant of hard to fund, valley of death. If you look at the picture on the left-hand side, in the sense that typically there's a high capital intensity or like a high capex for the projects, but also very high technology risks. Obviously, this varies if you look at the different SAF pathways, but but I think in some regions of the world, even if you're talking about a HEFA plant, I think in some regions of the world, those projects will still fall into this valley of death section of the picture. And what we've seen is that there really is a strong case for targeted public sector intervention in order to crowd in private sector funding. I think everyone can sort of agree that, public sector funding is necessary, but it itself is not going to be sufficient for the scale of investments that's needed, right, to scale up SAF production. So it really is a big question around what's the right mix of public sector intervention, or shall we say policy regulatory support, to crowd in or incentivize the private sector to mobilize capital towards these projects. Now, a concept I think that we're all familiar with, also I'm sure this has been discussed in previous webinars, is this idea of the green premium, where I think for SAF you're looking at a 2 to 4 times higher cost of production relative to jet fuel. But I think also relevant to think about from the financial institution perspective is that there's this, I guess, green risk premium as well. And we can sort of think about that of risk from a technology perspective. So I'm sure you're used to the idea of the technology readiness levels, right, the TRLs that you see on the left-hand side of this page. And very broadly, there is a higher technology risk premium for technologies that are less mature. So if you think about things like power to liquid pathways versus biomass or versus biofuels pathways today. And with that green risk premium, you would then also need a different mix of capital sources with the different risk appetites, right? But what you'll see here, I think, is that concessionary public capital, plays a critical role almost throughout the TRL stages, right? Based on what we've seen. I think that the key difference here, as you move through the different maturity levels, is that you have a slightly different mix across different capital sources, and depending on where you sit, it may actually be more complex to coordinate the right mix, mix of capital sources to form your capital stack in order to get a project financed, right? And that coordination role oftentimes falls to the project developers. But what we've seen, or I think what we've seen in other industries, is that it still remains critical to have someone that knows all the different stakeholders within this map to pull everyone together. We've done a bit of a mapping as part of our financing the transition work. We'll come to that at a later point. So before I hand over to Anne, just a very quick summary of the financial sector perspective in terms of investing in SAF production, right? I think there are several climate solutions or early stage technologies that require scaling up, and we all know sort of the big numbers coming from Clean Skies for Tomorrow, MPP, and IEA. But the big issue is that as things stands, the current financial system will probably not be able to deliver the scale of capital flows needed. And the main issues here are there are multiple market failures or risks that the private sector is unable to take today. And it cannot be resolved just by 1 or 2 banks or 1 or 2 investors stepping in and saying that they will do something. Instead, there's a real need to coordinate all the different stakeholders to co-design solutions. And a big part of that co-designing is some kind of public sector involvement via things like green surcharges or other public incentives. And finally, from the CapEx perspective, if we expand slightly to think of the public sector as also including the promotional banks, the multilateral development banks, and even in some cases, sovereign wealth funds, those bodies also have a critical role to play. So with that, hopefully you're sufficiently primed as we go through more detailed content that I will take you through.
Thanks, Jianyi. So the big number that we are currently talking about is that before 2030, we imagine that 300 SAF facilities are required worldwide that aren't yet announced or planned. So this aspect around blended finance and ensuring that policy is in place that mitigates some of the risks that investors are finding that are preventing them to be able to put the money in that builds these facilities is pretty crucial. Over the last year, I think you may have been familiar with from other webinars in this series, that amongst the Clean Skies for Tomorrow team, we produced, it was actually a year ago, this policy toolkit, which looked at a whole array. In fact, there were 36 different policy tools that could be used to look both at the supply side and the demand side. In fact, this slide, I don't know if I'm being impatient or it hasn't yet changed. Jianyi, perhaps you can, no, I'll do it. There we go. The policy toolkit is very well structured in looking at things that affect demand and supply, and the policies range from things that would require lots of government investment to other aspects that merely could just be that you need a strategy in place that provides some sort of certainty that there is a future within your country for SAF. And globally, there will be a future in every country for SAF for it to be used. And I imagine that a variety of countries that we don't yet see as fuel producers will become SAF producers so that we assure the vast volumes that are required for us to head towards net zero. There are two particular demand side measures, blending mandates and subsidies, that are very much discussed at the moment. And even though now I would actually say that supply is the issue because the demand is definitely there. And perhaps it is because those demand side measures have been put in place that we see that more focus needs to be put on to supply. And so the two examples that I'll draw on is the US policy, this Inflation Reduction Act, and then look at the European, that have taken very different approaches. I hadn't anticipated when I decided that I would quickly run through these two different policies that they would be so controversial, with talks of trade wars between the EU and the US. But we'll see how that plays out. But as I say, very different approaches. So the US Inflation Reduction Act is looking at putting close to 370 billion US dollars into creating energy security and climate change across the next 10 years. Their intention is that that would reduce the US emissions by roughly 40% by 2030. There are actually 4 different aspects of that Inflation Reduction Act that have an impact on SAF, and I'll very quickly run through them. On the slides, I've made sure that all the kind of key elements of those different policies, I might not dwell on all of them, but I know that these slides will be posted as well as this recording of this webinar, so you can have time to go back and look at the details, and there are links to the actual policies where I extracted the key information. So the first one is around US tax credits. So there is specific tax credits for SAF, and these, although there's 2, they're actually just sequential with different names. So in these early years, i.e. next year and the year after, $1.25 per gallon is available for SAF that has a life cycle emission of at least 50%. And then that gradually scales up to, if it was 100%, that you could gain $1.75. That then transitions in 2025 up, and this current tax credit is available up until 2027, such that that $1.75 per gallon of SAF, provided it has a life cycle reduction emission of 100%, is available. There are some other requirements around ensuring that there's correct wages and creating jobs in the US. But it's interesting that this current tax credit has such a short timeline, just up until 2027. And we'll see again whether that triggers enough investment in SAF that they extend it beyond, or actually it ceases to exist. But very, very much effort on triggering in these early years the use of SAF. They also have a policy to increase the technology usage and actually the production of SAF, and this is through grant funding. So they've got $240 million available for projects that are going to create SAF. And another 47 million for other low emission aviation technology. So that's the electric and hydrogen aircraft. There are a few aspects around how you can gain that funding, but what's really important to know from a global perspective is it is promoting the use in SAF production within the US. And so it is around job creation in the US. Two other kind of associated things that are related to SAF, I went the wrong way, is around carbon capture and hydrogen. And again, these are tax credits, so money for the production or of hydrogen or the storage, and slightly lower credits, but still credits available for the utilization of carbon. And obviously that's relevant to the production of synthetic SAF. And what's really interesting to note in this is it's a $3 per kilogram of hydrogen tax credit. And that actually is pretty enormous. And so will trigger quite a shift in terms of investment perspective around where hydrogen gets produced, and therefore where SAF facilities may be. And I guess that $3 figure is perhaps partly why there's this current controversy around what's happening in the US and the EU. So then let's look at what the EU policy is. The EU currently has in place the European, the emissions trading system. And that was used as an incentive for biomass-based SAF, although there is some discussion around how that will be extended to synthetic SAFs too. And that wasn't deemed enough. The European emissions trading system, along with CORSIA, wasn't actually deemed enough of an incentive. We haven't got enough SAF in Europe, such that within Europe now we have the Refuel EU policy. And that puts in place, rather than tax credits like the US has used, mandates for the amount of SAF that gets used within Europe and is produced within Europe from 2025 up until 2050. That is currently, it should come into force next year, but it's currently going through the legislative process. And interestingly enough, Parliament is suggesting that the mandates should be higher than was originally put in place. So if I very quickly draw on the real key differences. There's a policy difference in the US and in Europe. The US have gone for subsidies. They see that the government should initiate the change, whereas in the EU, it's definitely the polluter should pay. And so they've put mandates in place that ultimately will come down and be paid for by those who fly. The other key difference is around that Europe being a little bit more specific and prescriptive around what SAF can be used and the sustainability standards that are around those. And also both of the US policy and the Refuel have a far higher life cycle emissions reduction target than we currently see in CORSIA, with actually the EU being the highest, that you need to have 70% emissions reduction for the SAF if it's synthetically produced. What we're also seeing is that that mandate concept is being picked up in a variety of other countries around the world. And interestingly enough, even within Europe, where the mandates are likely to come in force next year, the European countries are putting in mandates already. We've seen that the France and the Netherlands have already got blending mandates in force. The concern around all this is how actually as an operator or a producer do you cope with all these different certifications for what SAF is, emissions reductions need, and blending mandates. But ultimately there's a lot of movement to try and to give the right security that SAF is the future for aviation, will be used for the short, medium, and probably pretty long term, and that therefore hopefully that helps mitigate some of the risks that investors see around building facilities. And with that very swift run through of a policy landscape, I'll hand back to Jay to talk a little bit more on the money side.
Thanks, Anne. So I guess before I jump in on this piece, just to situate this discussion back onto the investment perspective, right? I think Anne covered sort of two significant policy and I guess in a sense regulatory actions that have been taken in the US and the EU in terms of not just supporting SAF but other related clean energy technologies. And like I mentioned earlier in the call, public sector intervention is sort of a necessary component in order to give the private sector confidence to invest in the space, and that confidence would come from both the sense of both the regulatory certainty around SAF being the chosen or the right pathway for the short, medium, and potentially long term, as Anne mentioned, but also to really address specific market failures that exist in the market today that prevent SAF production from scaling up, right? And the idea of this intervention is that if you think about the development of solar power and wind power and sort of the technological components within that, right? Today, I think the statistic is that in more than 90% or 98% of the world, the levelized cost of electricity coming from solar and wind is lower than that for fossil fuel. But that's only possible, through that, I guess, decade-long learning period or experience curve where the cost was brought down as the technology scales up. And what we're trying to talk about here for SAF is really to start getting on that cost curve or experience curve so that the industry as a whole can learn and drive costs down and scale production up. But what's needed to get on the curve, right, is really to almost like get past the initial inertia. And that's really, what's, I think, what we're trying to talk about within our respective initiatives at the forum. And just to give you a sense of, how I think we've been thinking about, well, I guess how financial institutions and predominantly, I guess, banks today are thinking about the risks of investing in SAF or financing a SAF project. This by no means is this is not an exhaustive view, right, of all the challenges and all the risks, but I think it's worth talking a bit about some of these challenges to really, I guess, situate ourselves in some of the market failures that need to be addressed, right? And then think about this from an investor's perspective or a lender's perspective. And how we've looked at this is to really think about the risks and challenges that could emerge at different stages of a project. And I guess, it more or less corresponds to as well the different requirements for capital at different stages of the project. And what's important to know as well is that even though some of the challenges and risks come, that are assigned to the later operations or early operations part, these are all considerations, when an investor is making, investment decisions right at the start, right? And I'll give you an example as we go on. So straight away at the preparation part, I think this is where we talk about feasibility studies, feed studies, and things like that. And I think the big challenge here, that we've heard is the cost of development expenditure or development costs, right? This is typically on the order of a few $1 million for a project, which, if you think about a big producer like Shell, for example, is typically absorbed into their usual cost of doing business, right? But if you think about some of the pathways that are less technologically mature, there's going to be a high proportion of these feasibility studies that you start that would lead to a non-feasible, lead to you realizing that it is a non-feasible project. And today, this developmental cost is quite high, both from a financial perspective, but also from the perspective of trying to figure out how something would work. And that's really preventing sort of the smaller developers from entering the market. So if you're not a Shell, you may find it very difficult to kick off 2, 3, 4 feasibility studies, because that in itself is a huge financial outlay, but also because it may be that just one out of these 4 studies will lead to a project. And if you and once you get past that, right, and you think about after getting final investment decision or FID, during the design and construction process, there is this element of technology or completion risk, right? I think a lot of the underlying technology or specific components within SAF production, if you look at sort of the more mature pathways at least, is that they exist and are used already today, and they've been tested at a certain scale, right? But these different components haven't necessarily been brought together to produce SAF at the commercial scale that are being required today. And so what a lot of developers are seeing today is that, while the individual technology providers may be willing to provide guarantees during the construction portion of the project, right, there isn't really enough experience, so to speak, of the process of bringing all of these together, so that that somebody is able to provide a wrap for the entire project, basically to combine everything under a single construction contract, right? And that makes it very difficult to coordinate and costly coordinate for the developer. Now, then we move on to the early operations portion, right? When the facility is expected to make, to produce SAF and get through initial teething problems and also to generate revenue, right? I think this demand and revenue risk, or you could call it offtake risk, is something that is very salient to everyone and is a critical component to making SAF projects bankable today. And that's the idea that, there's the issue that SAF today is expensive to produce. And so, if SAF has to compete with the price of jet fuel, there is a very high revenue risk that any potential investor will be exposed to if they don't transfer that risk away. At the same time, I think there's a related to the price is also this it's also the worry about demand, right? So long-term offtake contracts don't really exist today. And without such a contract, at least for today, right, these projects are not bankable. I think that's just what we've heard from the various workshops that we have had. And then, if we talk about technology risk during operations, that's the idea that, nobody has done this for 20 years, so we can't really guarantee availability, right? And so there's a risk that the plant is shut down for more often than expected. And then also related to that is feedstock availability, especially if you talk about HEFA-based pathways or alcohol to jet. You need that steady access to the underlying feedstock, right? That isn't always available easily today. And that kind of access is not something that, you know, you can just magic up anywhere. I'm just being conscious of time here, but you know, this is very broadly the set of, I think, key market failures that we see today, and I would say a lot of this also would vary depending on geography and region, right? Because what we've heard a lot from our workshops as well is that local connection, local context, and I guess local regional supply chains are extremely important, because it's not always easy to move all of this, I guess, feedstock or technology or production around. And what we've done, looking at all of these market risks, or I guess all of these challenges, right, and market failures, is really develop a bit of a mapping of all the different players that need to be involved and what they contribute. It is a bit of a complex one, and you know, please take some time to think more about this if you're interested in the materials. But I think there is this coordination and interplay of stakeholders that need to come in. First of all, if you look at the top, like the top half of the picture, right, there is on the left-hand side the critical involvement of the industry, not just, you know, energy suppliers and sort of feedstock suppliers, but also technical firms that come in to either certify the biofuel or you know, provide other sorts of services. On the right side, on the right-hand side, there's, you know, off-takers, like I mentioned, or consumers play a critical role, not just in terms of, well, in terms of sending that demand signal to SAF producers to say that somebody will buy your SAF when you start producing, but also really to find a way to, you know, transfer some of that cost premium throughout the value chain to the consumers or other customers along the value chain. And then, you know, we can never spend enough time talking about the second half of this picture at the bottom, but there is, you know, quite a bit of complexity in assembling the right capital stack, right? Like I mentioned at the start of the call, across both private and public sector, right? And what I think Anne has introduced an earlier part really is, number one, in the EU, a blending mandate to help underwrite some of the demand signals, but also I think from the Inflation Reduction Act in the US, right, is this perspective of direct subsidies in order to make some of these early business models economically viable. And then the final piece, I think, which is the most conventional piece, is this idea of blended finance. And that really is to address the capital expenditure piece and the risks of investment, you know, into the capital, well, the risk of investment into the construction of these plants, right? And for the CapEx piece, I think there's a strong element of using tools like blended finance. But what that really means is, you know, there's a whole array of tools like either loan guarantees, grants, conditional grants, or convertible debt, things like that, which I don't think we have time to cover, that governments, export credit agencies, and multilateral development banks can deploy to really take off that, you know, maybe first 10 to 15% of risk, or I guess first loss, some people would call it, in order to make that remaining 85, 90% of the project, right, have the right risk return profile for private sector investors. So that's where I'll stop today. I think this will be interesting. So hopefully this context helps set up, you know, the intervention that we'll have from LanzaJet, who has received, I think, about 50 million of grant from the Breakthrough Energy Catalyst Fund. as well as 50 million, I think, from the Microsoft Climate Investment Fund. And I guess with that, Santi, back to you.
Thank you, Jianyi. So I'm conscious of time for Tony. I don't know if it would be possible to address a single question to him before he leaves. He has to leave in 4 minutes. So there was a...
Actually, okay, Santi, I can stay to the 1:15, so please, you can go.
Okay, perfect. Thank you very much, Tony. Very much appreciated. So then, just a reminder, I see there are some questions already coming into Slido here on the screen. You should be able to see briefly where you can log in. You have the details in the chat box. Now I'm pulling the video from LanzaJet. So as it was mentioned before, this is a producer, SAF producer, initially sitting in the US, but also with facilities and developments in the European Union and other places in the world. And I think it provides also a good and very relevant example of how things are being seen by the different parties, and especially for the organizations that are leading to, or leading, let's say, being affected by the financing of the SAF transition. So please, hopefully things will and technology work well. And after the video, we will move to the question and answers.
Hi, I'm Jimmy Samartzis, and I'm the CEO of LanzaJet. It's a privilege and an honor to be here with you today to talk about our view on what it takes to build the sustainable aviation fuels industry. Let's start by sharing with you a perspective on the fact that this industry is at an inflection point. For some of us, like myself, I've been at this since 2008, working hard over those years to put in place all the right pieces that are required to see this new industry take hold and to develop. And that cuts across things like policy and financing to technology readiness and airline participation. Let's start with the first thing, which is critically important, which is technology. Technology is at a tipping point in terms of it being commercially ready. Our technology is scaling not only here in the United States, but also globally. We have our first commercial plant, which will be operational in 2023. Our technology uses ethanol as a starting point. It is known as alcohol to jet, ATJ, and it was approved in 2018 by ASTM as a pathway that can get to sustainable aviation fuel. As a drop-in fuel that can be blended up to 50%. Policy has been evolving over the years significantly across different markets, and we've seen the benefit of that in places like the United States with the Inflation Reduction Act, which I know you've just heard about, as well as in places like the United Kingdom and in the European Union, where there are mandates that are in place to help demonstrate the demand for sustainable aviation fuels. Here in the United States, you have an approach with the Inflation Reduction Act, also known as the IRA, which is a performance-based approach to incentivizing the production of sustainable aviation fuel. We think this is a very attractive approach, which means that the lower the carbon intensity of the sustainable aviation fuel, the higher the incentive is that that fuel qualifies for. That's a very different approach than what you have in places like the European Union, but both are needed in terms of policies that are helpful. You see also in other countries, such as in places like Japan, where the government is stepping forward with sizable grants to help invest in the infrastructure that's required to build the industry. And you have countries like India, Australia, New Zealand, all who are currently in the process of developing policies that would be helpful in terms of building the industry. You also have users, meaning the airlines who are stepping forward to help catalyze the development of the industry. Some airlines are stepping in to invest in companies that have technologies and that are building plants. Other airlines are securing offtake agreements, which also help to substantiate the demand in the industry. Funding is the core of what I wanted to chat with you about. Funding has evolved quite a bit in the last few years. What we see today is that there is a lot of interest across the global landscape in terms of funding SAF technology and plants that will produce SAF. Those come in the forms of traditional banks who are beginning to get their arms around how to participate in this industry. You have infrastructure funds who are, actively engaging, and importantly, you have governments who are stepping forward with things like grant programs and loan guarantees that are extremely helpful to fund new technologies that might carry with them a little bit of higher risk. And then finally, you have consumers, both individuals and corporate consumers, who are increasingly interested in SAF. What I will share with you is on the corporate side, you have major corporations who fly on commercial airlines and who have a very keen interest to reduce their footprint and are helping to pay for the difference between SAF and conventional fossil-based fuel. This is an important segment that is helping to substantiate the SAF industry and helping to offset some of the costs that is expected to occur with first-of-kind technologies and new SAF production that is entering the market. At the end of the day, we need all of these things to work together to help us build the industry. And we say we're at an inflection point because we really do believe that all of these things are falling into place at different levels across the world, but you have in some parts of the world where all of this is happening, other parts of the world where parts of this is there already and others are developing. But by and large, there's momentum across the industry to build out the industry and get to commercial scale production. So innovation and funding is key to scaling technology, and we as a producer and as the world's leader in alcohol-to-jet technology are a key example of this. When we set up the company, we set it up with a core set of investors. We have folks like Shell and Suncor Energy out of Canada, Mitsui out of Japan, British Airways out of the UK, and LanzaTech, which founded our company, all committed to not only their first tranche of investment to the company, but also a further commitment to invest with us to build commercial scale facilities across the globe. So having this be part of the deal, if you will, from the very beginning, was instrumental to helping us accelerate the energy behind our technology and its commercialization. We also have government support. Our first facility, which is in Georgia here in the United States, is supported by the U.S. Department of Energy with a grant, which is extremely helpful, not only for that project, but we have similar situations in places like the UK and the European Union, where we have received grants that are helping us scale the technology, helping us to deploy it for the first time in those countries, helping to offset the infrastructure investment that's required to build out these new technologies at commercial scale. And then finally, we have strategic partners which have been proven to be extremely influential and extremely helpful. We have Microsoft, for example, has stepped forward to support the work we're doing in Georgia. And they are a company that leads with a climate-first focus and are extremely interested in the work that we're doing, not only in Georgia, but more broadly across the globe. So strategic partners can play a very influential role in helping to gain access to efficient forms of capital, as long as they're predominantly leading with the right intent. So let's talk a little bit about what this means in terms of unlocking global potential for new technologies. I'm sharing with you, this is our site in Georgia from a few months back. This is earlier this year. We were pouring the foundation of the refinery, and this is a picture of one of our employees at an off-site location where we actually have designed, engineered, fabricated, and built the entire refinery. It is done in a modular format, which is critical to getting to deployment quickly, and those modules will get set on the foundation that you see in the picture on the right that was poured months ago. This transition is already happening. The modules are arriving at our site in Georgia, so we are well underway in terms of developing the site and being able to hit mechanical completion in 2023. What this does for us, when we think about new technologies, as we get that commercial scale facility situated and operational, it unlocks for us a ton of value across the globe in deploying our technology in various countries, from the EU to India, Canada and Sweden to Australia, Japan, New Zealand, the UK, Germany. We have work going on across the global landscape. What's most important for you to understand in all of these cases is that innovation and financing has been instrumental. In places like the EU, UK, Japan, government support in the form of grants is absolutely critical in terms of investing in new technology and infrastructure construction. You also have different incentive programs across the global landscape in each of these countries that's either already present or is developing. All are going to be absolutely instrumental in terms of being able to, catalyze this industry and being able to have new SAF production take hold in each one of these countries. And then finally, I wanted to share with you a little bit about our Breakthrough Energy Catalyst Grant. We are the first recipient, of a grant from the Breakthrough Energy Catalyst Fund in sustainable aviation fuel. It is a significant honor for us to have been selected as that awardee for a $50 million grant. That is significant, and that goes directly to our project in Georgia. What that does do for us is it directly reduces the green premium. That grant funding, had we gone out to finance it with a financial institution, would have cost us an additional 85 cents per gallon of SAF that we produce every year, right? Every gallon that gets produced would have an 85-cent additional cost associated with it if we were financing it. Because we're the recipients of this grant, we're able to essentially reduce the price of that SAF gallon by 85 cents or more. 85 cents is likely on the low end. It enables us to continue to move forward with a sense of urgency. We didn't have to pause any of our efforts. We continued on the work that we were doing with that sense of urgency so that we can continue to build our project, build our facility, and ensure that we get to SAF production as quickly as possible. And then finally, it enables us and opens the door for catalyzing global growth across that landscape that I just shared with you on the international footprint of deploying our technology on just about every single continent. It enables us to complete the project in Georgia, it enables us to unlock all that value in deploying that technology then across the globe. And with that, I leave you with a final sentiment, which is that someday is now. We oftentimes hear that someday we will tackle climate change, someday we will have technology that's ready, someday we will have investment that shows up to support development of this new industry. What I'm here to share with you today is that someday is now. We believe that all of this is happening today. This inflection point that I referenced earlier is real, and that we are building the SAF industry across the globe. Thank you again for giving me an opportunity to be with you today. And sorry I'm not able to be with you live, but I'm signing off from Chicago, Illinois, here in the United States. Take care.
Well, I think it was very, very interesting, especially the last part where we see that despite of all the difficulties, there is reality and there is already developments, tangible developments, not only in the US, but also in Europe and in other regions of the world that are using these grants or this facilitation that the governments and financial institutions are putting in place. I think that's quite important also for continuing and ensuring that let's say these other things that needs to come are well placed. So I, again, conscious of time, I will jump directly to the questions. I think the best way would be that I place the question and then you, the speakers, so Tony and Jianyi, you decide who is best placed to take each questions that I will be addressing. For the people online, please continue placing your questions. I see we have 5 questions with which are addressing some, and I see quite specific to Southeast Asia or Asia, which is quite interesting. So the first one that I will highlight is, so I think there was at a certain moment, there was a mention in some initiative in Asia related to the Glasgow Financial Alliance to net zero. This may be Tony or Anne, maybe you are best placed to address it. So could you elaborate a bit more on this, if I understand, Asia initiative?
So yes, I think this one is for me. So the first thing to sort of say is our Asia Pacific network only started in June this year, so we're relatively young there. What we are doing though is we're building up some strategic projects for this year. I think it's worth saying that one of the things that we're trying to do is both raise awareness of what transition planning means amongst financial institutions in Asia Pac, build up those capabilities as well in-house for the financial institutions, and also that really contextualize what a transition plan really means for the Asia region as well, and then really support financial institutions in making their transition programs. And then two specific streams that look at coal power phase out and also decarbonising steel. Now, the reason that this is all important is because a lot of financial institutions also need to understand how to enact a net zero commitment, but also those financial institutions that haven't committed to net zero also need to actually understand how the transition will work and how they can deliver it. So those initiatives really are sort of part of that, raising awareness within the financial institutions, getting them to understand what it means to make a net zero commitment in a transition plan, and helping them and supporting them to do that, so that they can set financing targets into key sectors like aviation and help them raise that finance. I just wonder, there's another question down the bottom about Southeast Asia, which financial institutions, since it's easier for me to unmic now. There are a number of financial institutions. What I should say is it's not necessarily that financial institutions in Southeast Asia are taking leads in Southeast Asia, if you see what I mean. It is a combination of Southeast Asia financial institutions. In Singapore, for example, we have the likes of Temasek, we have some of the banks like DBS, UAB, but we also have large financial institutions across the region that are also investing into this part of Southeast Asia as well. So from China, from Japan, and from Korea as well, and also from Australia. So it's depending on whether you're looking for local finance or international finance on this. And also, I would say, a number of financial MDBs, the multilateral development banks, and also governments are taking this seriously, and quite a lot of the finance that will be flowing, and we aim to get flowing into these markets, comes in the form of blended finance as well as straight debt finance, or whether that's lending or through equity debt. I'll stop there.
Thank you very much, Tony. Indeed, the two links very well together. I suppose the Asia Pacific network is liaising with these institutions that you just mentioned, and obviously this awareness, establishing or facilitating the awareness on the transition, will unlock some of the resistance that these institutions may have to finance certain, especially for the big funds. That's quite interesting, and indeed that will be an initiative to follow on our side, to see what the discussions you are having and how we also can facilitate the connection with the aviation stakeholders, especially for the national organizations. That's quite interesting. Thanks a lot, Tony. Moving on maybe to connect it to the different policies, and obviously we always expect these kind of questions. This time is related to which are the winners, or who are the winners and losers of the US and EU approaches. I understand is, okay, you were comparing, and I think that will be more for you. You were comparing the two approaches, both are working, but obviously they are affecting in different ways different actors. So I understand that the question goes in that way.
Definitely. I mean, it's a very politically charged question at the moment, so I'm a little bit cautious about what I say. And also, I think that there's winners and losers in the short term, and then there's going to be winners and losers in the long term. If I focus on what's happening in the short term, because of the financial incentive to produce SAF and use SAF in the US, and because the majority of the production is out of the US at the moment, you find that airlines in a country where there's a mandate, like France, end up paying the penalty for the mandate because they actually can't get hold of the SAF. Whereas the US airlines operating out of California have the supply that they need at a reduced price because it's subsidized. So in the very short term, I see that's happening at the moment, but it's hard to speculate how it will play out actually in the long term, whether those paying penalties for mandates continues to be an issue because of the supply.
Thank you very much. They're very cautious in the in the wording, but it's true that obviously the analysis has to be fair in terms of long term and short term. In the long term, I mean, obviously the value of those policies in terms of reducing the risk and ensuring, let's say, this viability or the financial uncertainty of reducing the uncertainty, obviously has also a different aspect now with the long term, more long term in terms of mandates, or short term in terms of grant or tax exemptions and so on. But yeah, as I understand it, it's an issue that has to be dealt with care, because obviously there are not axiomas on that. Maybe connected to risks, and probably this I understand will be more for Jianyi, is what are the genuine risks? I think at a certain moment you were describing the risks and how these affect obviously the financial decisions. And the question is, what are the genuine risks for Indonesia or for Southeast Asia? Well, I don't know if you can be so specific as for a country like Indonesia, but if not, trying to widen it a bit to the Southeast Asia or Asia Pacific.
Well, I have to apologize to say that, even though I'm a Singaporean, I am not an expert on what SAF production looks like in the region. But I guess on a slightly more general level, when you talk about some of the countries in Southeast Asia, like the currency risk or the FX risks that come from financing projects in these countries become a bigger element than say in the US or the EU. I think Tony, you can also give a few comments on that.
Apologies, I'm going to have to drop off very shortly, but I was just going to say, I think it also plays to the question of talking to national financial institutions as well, and tying it in with nationally owned companies as well on this, including to oil and gas majors. There is a risk if one of the things that we're really keen on trying to do is actually upskill local finance to work with international finance to provide the sort of connection of there is local finance providing some of the particularly into supply chains, but also to this development. And the reason that's really important is as part of development for various countries, they need to build up their own industries as well. I think Anne really highlighted a key point there between EU and US. If you don't have your own infrastructure for this, your own capabilities, then the risk is that it becomes increased debt without actually the economic return. So I would say that's one of the risks. It then leads on to what do you address when you go to talk to national financing institutes and say, it's not just about funding the SAF plant itself, it's about funding all of the support infrastructure, the SMEs that will help that, and building up the economic development behind it so that you have a robust, sustainable aviation sector to help also with trade and bringing in that connection. So there's a lot of economic and development issues there. And just finally, on the oil and gas side of things, yes, absolutely, they have the balance sheet to do this. So there is also policy that would really help push them to also transition into this area. Apologies, though, I have to jump, but
thank you very much, Tony. Thank you very much for making yourself available. Thank you very much. So I think it was quite interesting, and especially as we are talking to Southeast Asian colleagues and mainly aviation people. Obviously, for us, and I'm including myself there, we have difficulties to get our head around the financial thing. I mean, how to access, what is our role there, and what kind of a speech we have to have with either the different Ministry of Finance or with financial institutions. Do we play a role as aviation, as civil aviation authorities? And obviously what you were just mentioning of this kind of a full value chain approach is absolutely necessary. Obviously, probably civil aviation authorities are not the ones to take, let's say, the lead in financial discussions, but for sure they need to be part of it, and they need to make sure that the whole system is consolidating and is ensuring let's say, a sustainable policy in long term that can be translated also in, let's say, lesser risks and a more stability for the investments. I think we exhausted the questions. Maybe some final thoughts on your side, and Jianyi, especially for the colleagues in Southeast Asia. More your experience and what would be your kind of recommendations for our aviation colleagues. As I mentioned, we are not necessarily so much into finance, and we have sometimes difficulties to understand what's next and what is our role.
I think what's emerged over the last few years is the way that the aviation communicate around their long-term strategy and around the role that SAF plays in that, and perhaps why SAF has taken so long to gain the traction that we've seen in the last few years is perhaps because of the complexity of that conversation around, are we going to build a different type of aircraft? And those outside aviation don't understand that even if we have hydrogen aircraft, we will still have a big fleet of aircraft that are fueled by SAF. And that key message is important for those that have money to know that it's not just to cover us until 2030, but actually it's going to be produced for 2050 and beyond. And therefore these are long-term investments that will pay. And coupling that with a government strategy that acknowledges that SAF has a place in aviation.
Thank you very much. And Jianyi?
And I guess, yes, and just to follow on Anne's comments, I think absolutely right. And as we move past, or as we move past some of these first of a kind projects across the different SAF pathways, I think one thing to remember, I guess, keep in mind, not necessarily remember, is that the scaling up, the large scale that's needed, will need to come from taking a programmatic approach to, finding financing, finding developers, finding all of the technology providers and putting them together, right? So really the next stage of scaling up will require really building platforms such that these projects or these deals can be done in a very, I guess, standardized programmatic way. And that's how you get the large number of plants that's needed.
Thank you very much. Indeed, that's the approach I saw Singapore taking with this pilot program on SAF, and there are some others in the region that are shaping. And I think obviously is putting everybody together, all the actors together, and making sure that the financial institutions are behind supporting. So thanks a lot, Anne, Jianyi, Tony already, he left to his duties, and obviously to the colleagues in LanzaJet. They have shared this very interesting video, very, very pertinent for the task. Let me just very, very, very briefly take back on the next workshops or the webinars. So next week we will start talking about the role of airports. In this case, Aeroport TV Roma with Fiumicino example. They will elaborate on their role, and also there will be a connection on the finance and the financing of their initiatives. I think that makes a very nice transition from financing to the role of the airports. Then next year probably will be ACA and an example from Asia Pacific. We will try to make it from the region, just to make sure that all the challenges and let's say the context is relevant for the audience that we are addressing. And then we will address some others on the role of the aviation authorities, very much connected to what I was saying. Sometimes we feel a bit, let's say, lost on what is our role as aviation regulators or aviation authorities here in SAF. And then also on sustainability certification schemes, also quite mentioned a few times on your presentation as well, as being a fundamental element in any development policy or financial development on this. So thanks a lot. Thanks everybody for connecting. Enjoy the rest of the afternoon for Southeast Asia, the rest of the day for the colleagues in Europe, and see you in the next webinar. Thanks a lot.